Welcome to Stark State College Institute of Management Accountants Financial Literacy Video Part 2. This video will cover credit, credit cards, and loans.
So I use two credit cards right now. I use them basically for small things like gas or like a little bit of groceries. Just because I know that I need to build my credit, because I come from a place where I didn't have any credit, and I know in the future credit is very important when I get older. So I want to be able to build it, but at the same time keep it disciplined and keep it in control.
There are 5 C's of credit that any creditor is going to look at whether you're applying for a credit card or a loan. First of all, they're going to look at your character. By that, they're basically going to look at your credit report to see how you've handled your debt in the past. Do you have a good credit score or a negative credit score? Then they're going to look at your capital. What assets do you own? Even if those assets are not being collateral on the loan, just to look at, do you have a house? Do you have a car that's paid off? Do you have some money in your savings account? Then they'll look at your capacity. What is your monthly income? Do you have the free monthly income to be able to pay this loan off? Then they will consider collateral. Say you are buying a car, that car is going to be collateral for that loan. Or if you're purchasing a house and getting a mortgage, that house is collateral for that mortgage. Then there can be unique conditions that they consider. It could be what's going on in the economy, could be if you have anything personal going on in your life or at your job. So those are conditions that could impact your ability to get that loan or to repay that loan.
I actually have 2 credit cards. One is a retail credit card and then one is a regular credit card. The retail credit card I use occasionally. I keep the balance low or I pay it off every month. And I got that one when I turned 18 to establish an age to my credit. And then the other credit card that I have for emergencies, if I need to, I use it every 6 months to keep it active. And I raise the balance I raise the limit every chance that I get.
Credit cards can be a wonderful financial tool if they are used responsibly. Some advantages are the ability to buy needed items now, whether you have the cash, whether you're not going to get paid till Friday, and you don't have to carry cash. That can be a pain, and it can be a little bit risky to have your paycheck and cash in your wallet. It's definitely more convenient than writing checks at every register that you go to, and you can consolidate all of your monthly expenses, for instance, your gas to fill up your car, your grocery store, your drugstore items. All of those could be made on your credit card each week, and then at the end of the month you make one payment. The disadvantages is that if you do not, I'll skip down to number 3, if you do not have the ability to pay off your purchases that you made that month, that is fine. There'll be a minimum payment that's due, but then that balance is going to carry over to next month, which results in, number 1, the higher interest. Sometimes credit cards have high rates of interest. It depends on your credit card. And then if you don't pay that balance off, they will start to be charged interest. There can also be bank fees. If you're a day late on the payment, they may charge you $39. There can be annual fees for having that credit card. And then the other negative of a credit card is that normally your limit is very high, so it does lead to impulse buying. You can purchase that high-priced item that maybe you don't need, or you can go on a shopping spree or go out to dinner, things that you couldn't do if you were just operating on a cash basis.
I myself, I do have a few credit cards, some retail ones, and I have one through my bank. I use the retail credit cards to raise my credit limit on paper because that's a part of your utilization, and that's a big part of scoring for your credit score. And my bank card, I really use it for the reward points. So they have categories every month, like if you spend money at Acme, or if you spend money at gas stations, you get 5% cash back. So if you were to spend $100, you get $5 back in bonus points. So I really use my bank credit card for just the reward points and benefits of that nature. And the retail credit cards is to raise my utilization, will lower my utilization and raise my credit limit to raise my credit score.
So the first thing you need to do is build a credit history. In order to do that, you need to have a steady work record or a regular paycheck coming in. Any bills that you do have, you need to pay promptly and regularly. You should also immediately establish, upon getting a job, immediately establish a relationship with a bank. In that bank, you should open up a checking and a savings account. Many banks have like a package that it does that, where you've got a checking, a savings, and a money market. They all can go together, especially if you're having a paycheck that's directly deposited into that account. And normally there's no fees if your paycheck is being directly deposited. Then when you have that checking account, use that checking account to pay your bills. Do not bounce any checks. Open in that savings account, have a regular amount of deposits, whether it's coming out of your paycheck or an automatic transfer. Then get some credit. The easiest way to get a credit card is to go to a local department store and get a small amount at that store, small credit card amount at that store, and then make some purchases and then pay those purchases off. Then once you have a little bit of a credit history, you could apply for a small loan. Many times your banks will offer you a small loan, especially if you have a decent amount in your savings account. And then if you do need to get a larger loan, such as for a vehicle, you can always get a cosigner. Then your cosigner is going to enable the bank to give you that credit, and then it's going to build your credit as you make those payments.
So establishing smart credit is very important because after the age of like 21, everything you do is based off of credit. Even jobs, a house, even if you have no money, they still want to see your credit and basically that's just telling them that you know how to be financially stable enough to be able to afford whatever you're doing and keep it up and not just buy it and just do nothing with it or they'll lose capital with it. So that's very important because in my future I want to do stuff to be able to use my credit, of course, like a house and a car, and I just don't want to be plain and get something that I don't like when I know I can't get that if I just build my credit.
There are 4 different types of credit and sources of credit. The first one is just your single payment credit, such as your utility bills, your cell phone bills, your cable bills, things that they don't give you an amount that you can go up to. They're just going to charge you for what you use that month, and your bill will be due accordingly. Then there's revolving credit, where that would be with a store or a MasterCard or Visa with your bank, and you do have a limit. So maybe your credit card has a $2,000 limit. You can make purchases up to that point, and a minimum payment is required. You can always pay off the full balance anytime you want to, but the bank will at least ask for a minimum monthly payment to be made. Then there's installment credit, where you go out and get a car loan or a boat loan or a loan for appliances or maybe furniture, and they're going to set you up on a monthly payment plan. So you pay the exact same amount each month, and within that payment, interest is included as well as an amount that's reducing the principal balance. So maybe you have a 5-year car loan and you'll pay that exact same amount each month for those 5 years, and at the end your car will be paid off. Then finally there's mortgages. So mortgages can go 15 or 30 years, so they're longer term loans, and those too include your interest payment each month as well as a reduction to your principal loan balance. With mortgages, there's also an amount that goes into what they call escrow, and that covers your property taxes and your property insurance, which will make your monthly payment higher. But those two will be a set monthly payment that you will make each month.
Establishing smart or good credit score is important because if you have a low credit score, you're costing yourself a lot of money. Low credit score causes you to have to sign on for debt at a higher interest rate, because when you use credit, you're basically borrowing money from somebody else to make a purchase. So if you have a low credit score, you might have a 15% interest rate versus if you had a good credit score, it would be a 2% interest rate. So a low credit score would be costing you more money in the long run.
When you're first getting credits and getting loans, you want to make sure that you are responsibly picking balances. So there's some general rule of thumb. If you should not borrow more than 20% of your yearly income. So say you earn $24,000 a year, 20% of that would be $4,800. So say you're going to go out and get a car loan, that should be the amount that you get. Say you're going to get a credit card for furniture or for household items, that should be the amount that you would get as your maximum amount, is the $4,800. Mortgages, if you're going to go out and buy your first home, the amount that you get in the mortgage or the amount that you borrow for that house should not be more than 3 times your annual income. So again, if you're making $24,000 a year, you could afford a $72,000 mortgage. Hopefully you're putting some money down, so maybe the house could be $80,000 and you put a 10% down payment and you borrow $72,000. Your monthly payments should not exceed 10% of your monthly income. That does not include your mortgage. Your mortgage can be about 1/3 of your monthly income. So again, if you have $2,000 a month, a $200 monthly payment on that car or on that credit card is the most that you could afford.
Loans are actually tricky because, like I said, anything with credit or borrowing, you're going into debt and you owe somebody else. So if you have a good credit score or a bad credit score, could determine how much money you end up paying back. But for things like school loans, I wouldn't try to go too crazy into debt because you can see our country is in a student loan crisis right now with a lot of people who took out more than they could afford. So make sure when you're taking out things like student loans, it's the career path that you're choosing to chase is going to be something that you can actually make enough money to pay those loans back. But I'm not really a fan of things like car loans and things of that nature because the car depreciates and you don't make your money back. But things that you get loans on, like houses that you can actually make money off of, I am a fan of those. It's just all about having discipline and managing your money right so you could actually pay those things back. But before anybody worries about getting credit or loans or things of that nature, I like people to be disciplined with their actual money, because if you're disciplined with your money, then I believe you'll be fine with paying back loans or lines of credit and things of that nature.
Credit card do's and don'ts. If you're getting your first credit card, make sure you shop around. Compare various banks and credit card companies to see which is giving you the best terms. Keep in mind there's cash back bonuses, there's reward points, plus the amount of interest they're going to charge you. Make sure you consider all of those. Read that contract carefully and understand it. Know what happens if you miss any payments and know what the maximum amount of interest that they can charge you is. Then figure out your total price that you're actually paying if you do make those minimum payments. Ideally, you should make the largest payment possible. That may be the entire amount that you charge that month. That would be ideal. Again, know your penalties, and then use that installment credit only after you've considered any other possibilities. Sometimes at furniture stores and appliance stores, and I mean even sometimes at your car repair shops, they will push you into getting their credit card and hey, 6 months, same as cash, those types of deals. Just make sure you completely understand what you're getting into before you sign up.
When determining what type of loan you should get, you should shop around and try to get the best interest rates, not get a loan that is more than you can afford. I would say a loan that you could make 3 months payment if you were to lose your job is a reasonable amount.
When getting a car loan, be a smart buyer. First of all, shop around, not only to different dealers to get the best car, but also for financing. Many times the dealer will offer you financing, but you can also get car loan financing from your bank. So make sure you check out both before you make any type of commitment. And if you do agree with the dealer financing, or again, even at your bank financing, just ask about what rate of interest is being charged, and also ask if there's any prepayment penalties, because if you are budgeting and you're trying to reduce your debt and you want to make extra payments on that loan, you want to make sure that you are saving interest if you do that. Be an educated buyer. Consider what cars you want. Know your price range. Understand the differences between if you lease that vehicle, what costs are involved versus if you purchase that vehicle. There are certain people who do better under leases. If you're a person who wants a new car every 2 years or 3 years and you don't put a ton of mileage on it and you're going to take care of that car, a lease might be the right option for you. If you do drive a lot, or you're going to have it dinged up, maybe based on where you park it or where you drive it, you're probably going to want to purchase that vehicle. And then finally, know the cost that you're willing to pay for the vehicle itself and how long you want your car loan to be for. If you only want to pay a certain dollar amount and have a 5-year car loan, do not let the salesman try to negotiate you into a longer term loan so that you have a lower monthly payment and then you end up buying a more expensive car.
So when determining a loan, I always want to see if the loan is actually needed in the first place. If I can able to provide for it with my expenses, if I take some stuff out or if I add some stuff, am I able to pay off whatever I'm trying to get a loan for? If I do need a loan, however, I want it to be able to be paid off, of course, every single month, and still be in principle where it's not too much debt that I can't pay off. But if it's still needed, I'm gonna have to take